Hey guys, it's our dividend guy here, and today we didn't do too bad. A happy Wednesday. Hopefully you guys are having a great day. Today I traded kind of sideways. I made a little bit of money, but I still consider it sideways if it's less than like $60, 50, $60. So I did a little bit of a gain today, not too bad. Made about 0.2% gain today. Still above 15.5, which is the goal. I don't really want to hit below 15.5 anymore. Once I hit a certain point, I want to keep going up from there. So 15K was the first one. Now we're at 15.5. Eventually it'll be 15.6. See what I mean? So as I get like $100 more, $100 more, I don't want to go below a certain point. So we're doing good there. So I kind of traded sideways. If I don't gain like $100 to like 75 to $100 in a day, I consider that sideways. If I lose $20, if I gain $20, it doesn't really matter to me. It's nice that I'm up, but it doesn't do much for me or the portfolio. As you can see, it was only like a 0.2% gain. So on the week we're down. ExxonMobil's been really volatile, and Altria Group had all that bad news about the Juul thing and the people, how many people have passed away, and they're gonna do more regulation on it. So not surprised there. There was a couple articles that really bashed on Altria Group, so that did fluctuate my stock price, and that did become a really big percentage of the portfolio because I doubled up on the amount of shares that I had for Altria. So that does not surprise me that I was a little bit more volatile last week. Because remember, guys, I had FRT, which I will be buying that again. It was just overpriced, and Altria was at a good premium price for me. So I doubled up on shares, sold out of FRT, used that income from the sale to buy more shares of Altria. So I doubled up. But when I did it on kind of a bad news week. So I got a good price, but then it fell lower. So again, you can't time the market. Just got to keep riding out the fluctuation. Not mad about it. That's just how it goes. And I'm happy I can document the journey for you guys so you can see exactly that's not a mistake. I wouldn't consider that a mistake, but you know, that's just how it goes. When you switch out positions or you find a better opportunity, you have to deal with the fluctuations in the market, and that's totally fine. So for the week, we're down a little bit because Altria and other stocks were a little volatile. Not a big deal. For the month, we're up 5.57%, which is $820. So not a bad gain there. Almost $1,000 in the past month, so that's actually really good. That's three months of my rent, so that's awesome. For 3 months, we're up almost $1,300, so almost 9% the past 3 months, which is great. Again, a lot of this has to do with this does not actually include dividends, so that's awesome. So this is just on stock price alone and gains in the stock market, so that's awesome. For the year, we're up 1263, which we're up a little bit more on the 3 month than we are the year, but that's okay. Up almost 9% for the year. And then all time, we're up almost $1,000. So that's just pure growth. That's not me. That's me adding money, but that's growing on the added money on the principal. So that's awesome. That's interest growth. So, and that doesn't include dividends, like I said earlier. So my returns are even better than that. I wish that that's one of the things that I dislike about Robinhood, and I think most of the other brokerages don't add dividends as well. But I'm making like $857, I think. It's probably more now that I doubled up on Altria. But they don't include dividends or dividend reinvestment, so that there's no drip program. So that's one of the things that I actually prefer about M1 Finance is that they have a drip. So, oh cool, I'm up a straight $1,000 now for the year. That's awesome. Or all time. It's cool. So we're making gains, I can't complain. It's a good Wednesday. We're in the green. So let's take a look. See who is winning and who is losing. All right, let's look at all. I'll just go down the list. Altria, let's take a look. We're up on Altria. Awesome. We're up on Coca-Cola. Of course, up on AT&T. That one's going to be up for a while. Same with AbbVie. I got in at pretty good prices. Remember, like I said, I bought before the Warner assets were actually included in the stock price, in my opinion. So that's why I bought it at 31. I wish I could have bought it lower, but that's okay. I was in this stock early. Like, this is one of the first stocks I ever bought, and I'm very, very bullish on AT&T. AbbVie, you guys saw when I bought that, I believe. That might have been a little bit before I started documenting, but I bought 60 shares, $72. It's at 79 now. I'd still buy it because it's still way below 52-week highs, so it's about $20 still. Not too bad. Exxon, I'm down big by like $10 a share with 30 shares, so about $300 down, which is fine. Can't really complain about that. It's whatever. It's paid a dividend it's the third longest dividend payer in like history, so I'm not worried about it. Target again is another Exxon's a dividend aristocrat, but Target's a king, so I'll be buying this for the rest of my life too. A lot of these positions that I bought, I'm gonna keep buying. So Again, great price. Got in at 87. It's at 107. So getting great growth on the stock price. But plus, I'm doing it for the dividend. That's why I bought the stock, because it's a dividend growth stock, and it's second biggest retailer in the world. Walgreens, them and CVS were both on my watch list for a while, but I picked WBA just because it had more organic growth. CVS is more of an acquisition growth. They grow through their acquisitions. Walgreens has grown through actual growth of like buying stores. They don't buy companies necessarily. They've done acquisitions, but that's not the main catalyst for their growth. So that's why I bought them instead of CVS. But anyway, they're up $1.26. It is funny because like, so when you look at the fluctuations, right? So like, of course, the stocks that you hold more of, you're gonna get more of the fluctuations. So you're gonna be up more when they gain, and down more when they lose. That makes sense. But it's funny because like, if you take a look at how much I've gained or lost on WBA with one share, that's kind of crazy, right? Like, think about that. That's one share, and I made $1.26. That's a pretty good. What percentage of growth is that? 2% growth, but on one share, so that's crazy. That's one of the things that I've been looking at. Is like, dang, every day it seems like, whether it goes down a dollar or up 40 cents, like that's a pretty big jump considering it's one share. Sorry, I love Chris Hogan. Here, I'll turn that off for now. But I will watch that later. Chris Hogan. Sorry, guys, didn't mean to click that. Surprised it doesn't happen more often. Sorry, I get YouTube notifications from people that I enjoy watching. So Chris Hogan's definitely, and Dave Ramsey are two guys that I really like to watch. So the thing that I did, I changed up my watch list a little bit. I kind of based my buys off of what Warren Buffett's been buying, which I'm not buying them because Buffett bought them. I've actually done a lot of research into Delta, Bank of America. I've been doing a lot into the banking sector, and as you guys know, I've had Johnson & Johnson, 3M, and Genuine Parts on my watch list for quite some time. But what I started to do, and I recommend this for newer investors as well. So the quote unquote value by Benjamin Graham, the PE for the market is 15. That's what you want. So if it's above 15, then the market is overpriced. If it's below 15, then it's a value stock. Technically, that's how you would gauge it, right? So instead of ordering them by when they pay, which is what I was doing before. So like FRT pays one, Leg pays one, Lion Energy pays the second month. So Leggett and Platt and Federal Realty pay January, Lion pays February. But these are all mixed up because Illinois Tool Works pays in January too. But as you can see, that's just how that I had them organized by when they pay, right? But instead, I went through and all of the stocks below the S&P or SPY are overvalued technically by the market. So I'll show you what I mean. So, and this is just something that I've done this for a while, but I've never shown you guys. So I'll just go through it real quick. So the market technically right now, so the S&P 500 is the market benchmark, right? So that's the value of the market technically. That's these 500 companies reflect the economy. That's what the ETF does technically. So if the PE of the market is at 22, then you can use that to determine whether or not your stocks, regardless of price, are overvalued. So I don't go by the price, I go by the PE, how much I pay for what they earn. So like, and it's funny because if you compare stocks, so let's look real quick at Procter & Gamble. So Procter & Gamble is a great stock, dividend king. I will buy it eventually, but not at these prices. So, and here's why. So as you can see, Procter & Gamble is close to the 52-week high at 125.17. Look at that PE. It's an 82. So let's go back and let's see what the market was again, just so you guys can see. So the market is at a 22. So it is 4 times more expensive than the overall market. So our goal as investors is to buy low, sell high. So there is no reason why we should be buying, honestly, I think any of these stocks. Like, let's take a quick look. I'll just slide through real quick. 42, so double the market. You are a little bit more expensive, but still not close to 15. So the only two so far that we might be able to buy that I might say are decent buys are Leggett and Platt and Alliant Energy. EPR Properties, that one would go into that as well. But look, Illinois Tool Works, so I kind of organize these. Lowe's, nope, overpriced. Waste Management, it's a little pricey. Procter & Gamble, no way in hell I'd buy that stock right now. American Water Company, but it's still too pricey for me personally. Walmart's a little pricey. See what I mean? And then PSA is a little pricey as well. So as you can see, there are some stocks like the Procter and Gamble's and American Water that I love the stock. I love the dividend payments. I'm going for long-term growth for dividend payments. And they are a catalyst for that. They fit in that mold. They're in that tunnel vision stock. They're in that category for me. But I cannot allow myself to buy at those prices because I'm paying more for what they earn, right? So I have to fork up more money for how much money that they're generating year over year. So honestly, I wanted to go through and see exactly how much I would be paying. And here's the crazy thing: you can buy Procter and Gamble right now, and it's an 82 PE, or you could buy Johnson and Johnson at a 20 PE. They're both highly diversified. They're both great companies. They're both dividend kings. They have great growth history. They're, like I said, they're diversified. They're good. They're good stocks. Like they perform very well. So um why would I pay 4 times the price when I could buy Johnson and Johnson for half of that? And again, like look at the prices though. Procter and Gamble is about the same price, but you're paying more for Procter and Gamble technically on a PE standpoint than you would be for Johnson and Johnson. So let's take a look at like say 3M. 3M's at a 20.6 and Johnson and Johnson is at a 20. So they're priced a little bit under market value. They're not at a 15 where I would buy them, but I would still consider them a buy. So we did 3M. Let's look at Genuine Parts. Again, another dividend king. So what I did is I went through and I found kings that are fairly priced in my opinion, which they're closer to a 15, which means that Genuine Parts for me personally as a dividend type investor, I would be more comfortable um, buying them right now. Like that's less risk for me because if you buy the stock cheaper, sorry, I was talking to people on Spotify or Snapchat, but this is a better buy for me. And then if you look at JP Morgan Chase, they're at a 12. They're a big bank. They're at 12. I think they're a dividend aristocrat. So they again they not only fit my mold, but they're at a value right now. Even though they're close to their 52-week high, which is crazy, but they're at a value technically right now from a PE standpoint, and they have great dividend growth. So again, I would buy them. Cardinal Health, again, cheap dividend stock. They're a dividend aristocrat. So again, in Bank of America, same thing. They're not a dividend aristocrat, but they're one of those stocks that have paid and they've increased it by a decent percentage every year. So again, this just goes to show that and then there's Delta, which is at like a 7, I think. Yeah, then that's just dirt cheap. So again, I know I'm a dividend growth investor, and most of these stocks still do dividend growth. Three of them are kings, 2 of them are aristocrats, and the other 2 are just such deep value plays that I don't know if I can ignore them. So again, guys, it's just different strategies, and that's the thing. As an investor, you don't have to be just a growth investor, just a dividend investor. You can switch it up. There's no rules to this game. Wow, I thought after hours we were at $3 before. Now we're up to 23. That's good. That's a good gain. But keep in mind that you don't have to do you don't have to play one game with this. I wouldn't day trade or do penny stocks or Bitcoin, but there's nothing wrong with finding stocks, organizing them by their PEs, and paying for the cheapest stocks on your watch list, or watching when your stocks or the stocks that you want go down on a low PE, because then you're paying for less. Like you're paying less for the same company, right? So think of it like the new iPhone. So you could get the new iPhone for $1,100, or let's say next year you get it for $500. It's the same iPhone. It's the same thing with companies. Or like maybe you go out to dinner and you usually get the steak, and one night instead of $17, the steak is $6, and it's the same cut of steak. You just get it from like 50% off. That's what you should do with stocks. And when you see the value of, like, let's say you go out to dinner and get that steak, you get a better value for the same thing, right? So why would you not have the same mindset in the stock market? I'm not saying that there's anything wrong paying a premium for good companies, because there is not. I don't think there's an issue with it, but just personally, I wouldn't do it. Like right now, no way I would buy Procter and Gamble or American States Water. But I would buy Johnson & Johnson and 3M and Genuine Parts Company, because they're at a price that I can, not necessarily at a price tag, because that's not how I'm evaluating these stocks. I don't care about the price tag. I care about the underlying business, their assets, how much they make year over year, how healthy the business is, and how diversified it is, and how it's performed in market crashes. And all 3 of those stocks Johnson & Johnson, 3M, and Genuine Parts, they are dividend kings. They have a safety net. They're safer than, say, like a CenturyLink or a Ford or a GM. They have a proven track record, and if I can get them at a basement value, then that's a win-win. That means that I get that dividend, I get the dividend growth, which is my main thing is I love dividend growth, right? So I can get the dividend growth. Not only can I get the dividend growth, but I can get the safety of having the dividend, because that does give you a little bit of a safety for the stock, and I can get them at basement prices. So if I get in at the right time, if and I'm not saying time the market, but I'm saying when I can get in when the stock is priced where I feel it's undervalued, I buy it, and then I have more growth potential, as I did with, like, say AbbVie, because AbbVie's had great growth for me, and AT&T. If you as an investor can figure out exactly how much, or you can value a company and you're off, a little bit, which is fine because there's always room for margin of error. Think about it this way. I bought AT&T at 31, and I said the assets of Time Warner, it's a billion-dollar company. It's a huge entertainment company. They have, rights to, like, Harry Potter, like Iron Giant, Looney Tunes. There's just a lot. DC. They have assets, and they're not realizing the stock yet. So I bought a bunch up, and now it's running up because now some rich hedge fund, 6 months after I buy AT&T, says Warner assets are going to make this go up. We're going to cut DirecTV, and then we're going to pay off the debt, and then it's going to skyrocket. It's like, yeah, I already know that. So once you become, and I'm not even, honestly, I'm not even that good of an investor, guys. Like, I'm really not. Like, I'm really new to this. I've studied a lot to get to where I'm at. So, um, don't be afraid to play the game. Do value, do deep discounts for stocks, do dividend growth, do some growth stocks. Have a little bit of diversification, not only in the not only in how what stocks you pick, as in, like, the sectors, but also change up your style. There's nothing wrong with a dividend investor like me buying some Amazon or buying a Facebook, because that's going to push the portfolio up. Yeah, I don't get a dividend, but I still get great companies. So don't be so shallow with your company selection. Be open to new investments, to new ideas, and just that's going to really help your growth. And keep in mind that, don't just factor in price when you buy stocks, and don't just buy a stock because it's cheap. Buy a stock because you like the underlying business. So anyway, sorry for the rant, guys, but I think it's really important that people understand where I'm thinking, where my mind's at, and exactly how I'm choosing to invest, because that's what you guys are watching for, right? Like, you want to see me invest, you want to see this portfolio grow, and you know what? It doesn't have to just be about dividend growth. That's what I want it to be about. That's what I'm comfortable investing in. But eventually, I would love to buy something like an Amazon or a Facebook. And I love buying stocks at deep discounts. Look at AbbVie or AT&T or even Target. I have like 3 or 4 different things. So I've been doing the value play. I just haven't talked about it yet. So I wanted to change that today. Anyway, so look for deep value, find stocks that you love, and if you find a stock that you love on deep discount, then buy it up. And don't be afraid to invest in the stock market, guys. That's the best wealth generator you can find at the prices that you can get in at. So thank you guys so much for watching. I appreciate it. I love all my subscribers. Thank you guys so much. I've been growing so much, and I've been getting likes, comments, and views. And I'm not doing this to get famous or anything like that. I really just love dividend investing, and I'm very, very blessed with the friends that I've made. So thank you guys so much for watching. Remember to not only diversify your portfolio, but diversify how you invest. And I'll see you guys tomorrow with another update. Thanks for watching. It's been that Dividend Guy. See you tomorrow, guys.